1 minute ago, something shifted in the silver market. Not the price, not a headline, not a rating change from a bank that is always 6 weeks behind the move it should have seen coming. Something structural. Silver is trading at $90.11 per ounce right now, up more than 162% from this exact date 1 year ago. That price alone should be stopping people in their tracks. It is not, because most people are still looking at price. The ones who matter are looking at structure. And tonight, at exactly 5 p.m., a specific, measurable, historically rare structural signal activated in this market, the kind that has appeared exactly 3 times in the last 45 years. Every single time it appeared, the people who were positioned before the resolution were rewarded with moves that permanently changed how an entire generation thought about precious metals. The people who read the headlines afterward watched the window close from the outside. That is the pattern. That is the distinction. And that distinction is the only one that matters right now. That pattern is live. Tonight, February 26th, 2026, 5 p.m. And this window does not stay open. This is John O.G. Reports. This channel has never sold you a single product. No course, no membership, no alert service, just the map, delivered before the destination becomes common knowledge. If you are new here, subscribe right now. Because what is converging in the silver market at this exact moment is not a price story. It is a structure story. And structure, when it fractures, does not issue warnings twice. Let's build this from the ground up. Start with what happened at 5 p.m. Silver broke out of a contracting triangle formation on its primary chart. Not a hypothesis, not a projection, a documented, observable, measurable technical structure that had been compressing for weeks, building pressure, building tension, coiling tighter while traders on financial television debated direction and analysts issued contradictory forecasts. And tonight, that compression found its resolution. This is not the first act of this move. It is the second. Silver already staged a 24% rally off its post-crash base in the low 70s. That rally found the floor at precisely the 61.8% Fibonacci retracement level, which is the level that technical analysis uses to confirm whether a structural low is legitimate or temporary. It confirmed, and now, on top of that confirmed structural low, the price has broken upward through the triangle's upper boundary. Technical analysts have immediately identified $92 to $94 as the next meaningful resistance zone. Beyond that, $100 is the psychological threshold. It is also the number that Citigroup, the 5th largest bank in the United States, is now officially targeting. Not by year-end, not by summer, by March. Citigroup revised its silver outlook in January, after silver had already surpassed $100 during the parabolic surge, and they are still targeting $100 as a near-term base case. Their upside scenario is $150 within 3 months. Their reasoning is not speculative commentary. They cited an acute physical shortage of deliverable metal. They cited COMEX registered inventories down more than 70% since 2020. They cited industrial consumption from solar manufacturing, electric vehicles, and AI infrastructure hardware absorbing record quantities of metal, while global mine production grows at only 1 to 2% annually. The 5th largest bank on Wall Street is telling its institutional clients in writing that silver at $90 per ounce is cheap. The triangle breakout tonight is the technical confirmation of what that statement implies. The structural floor below this market has moved materially higher. Where the ceiling lands is a question no one can answer with precision, including anyone who tells you they can. The triangle breakout is important. What sits beneath it is more important. The most recent Commitment of Traders report, February 17th data, the freshest reading currently available, shows managed money net long positions in silver futures at just 5,472 contracts. Sit with that number. During the parabolic January rally that drove silver from $83 to $121, hedge funds and commodity trading advisors were positioned at multiples of this level. The speculative complex was fully deployed. That deployment was a primary engine of the move upward. It was also the accelerant that made the crash catastrophic when margin requirements were raised and forced liquidation cascaded simultaneously through thousands of leveraged positions at once. Those same participants are now at historic lows in net long exposure, 5,472 contracts. In a market where peak speculative positioning reaches into the hundreds of thousands, the heavy artillery is not in the field. Here is the precise implication of that number for tonight's breakout. This rally, a 24% surge off the lows, a triangle breakout, a reclaiming of $90, is not being built on speculative futures positioning. It is being driven by something categorically different: physical demand. Real buyers acquiring real metal. buyers who are paying 8% annualized lease rates in London because they cannot source the metal through standard channels, buyers who are pulling physical delivery from COMEX at rates 7 times the historical average, buyers like Samsung, which bypassed the exchange system entirely and locked up 100% of a single mine's output for 2 full years through a direct prepayment arrangement because it no longer trusts exchange-based procurement to reliably deliver at scale. This is the critical distinction between January and tonight. January was a paper rally, enormous in force, built on leverage, demolished when the paper structure was attacked. A physically driven rally on historically light speculative positioning has a completely different character. There is no crowded leveraged long to liquidate. There is no margin cascade waiting to detonate. There is only sustained, structural pressure from buyers who need the metal and will pay whatever the market requires to secure it. The January explosion was paper. What is forming now is physical. Those are not the same animal. They do not break the same way. They do not resolve the same way. Now connect all of this to the lease rate, because this is the number that makes 5 p.m. tonight specifically significant rather than just another closing session. In a normally functioning silver market, the 1-month lease rate, the annualized cost of borrowing physical silver for 30 days in London, sits between 0.3 and 0.5%. Essentially nothing. Metal is plentiful. Lenders have no urgency to charge more. Nobody pays to borrow what is readily available through normal channels. In October 2025, that rate spiked to 39% in a single session, the largest single-session spike in the recorded history of the London silver market. It moderated afterward. It came back down, but it did not normalize. Entering this week, it has been running between 7 and 8% annualized. That is 7 to 8% to borrow silver for 30 days in a market where the historical baseline is 0.4%. What does that number mean in mechanical terms? When an industrial buyer is paying 8% annualized to borrow silver for 30 days, they are not doing so because it represents an attractive financial transaction. They are doing so because the alternative is worse. You cannot pause a solar panel production line or halt semiconductor fabrication because borrowing costs are elevated. The metal is a mandatory industrial input. Buyers pay whatever rate the market demands, because operating without silver is catastrophically more expensive than paying for expensive silver. At 8% lease rates, the arbitrage mechanism that normally equalizes prices across global exchanges breaks down completely. Carrying a short position, which requires borrowing metal to fulfill the delivery obligation, becomes structurally prohibitive even before any adverse price movement is factored in. The record short position in SLV, the iShares Silver Trust ETF, the primary institutional vehicle for silver exposure, documented in the most recent COT data, represents entities now paying approximately 8% annualized in implied carry cost to maintain positions against a market that has already rallied 24% off the lows, against a COMEX first notice day arriving in less than 48 hours, a deadline that will force position decisions that cannot be postponed, negotiated, or redirected. The geometry of that situation has a direction. It does not point down. Tonight produced a fourth signal simultaneously. Silver's implied volatility, the options market's real money measurement of expected price movement over the next 30 days, has spiked to levels that have historically aligned with every major structural breakout moment in this metal's modern history. Options traders are not speculators in this context. They are risk managers pricing known structural exposure. When they pay elevated premiums for protection against large price swings, they are communicating structural risk with actual capital on the line. They are not forecasting. They are hedging against a known probability distribution that they have already quantified with precision. Elevated, implied volatility. A confirmed triangle breakout. Physical lease rates at 8%. Speculative positioning at historic lows. A COMEX first notice day 48 hours away. Multiple independent signals arriving at the same structural conclusion from completely different directions simultaneously. There is a name for that in market analysis. It is called a convergence. The last time this exact convergence appeared in silver was October 9th, 2025. That was the day lease rates spiked to 39% in a single session. That was the day silver shattered its 1,980 price record and set a new all-time high above $50 for the first time in over 4 decades. The session immediately before that historic breakout looked structurally identical to tonight's 5 p.m. session. The structure gave a specific signal. Most people missed it. The ones who were already studying it did not. Now the counterargument, with full precision. Because this channel's credibility is built on showing you what can fail, not only what is working. The triangle breakout tonight is technically valid, But declining COMEX open interest in the February silver contract is a real concern. Rising price accompanied by falling open interest is the classic signature of a short covering rally. Traders who went short after January's crash buying back their positions to close, not fresh conviction capital entering the market on a structural thesis. Short covering rallies have a natural ceiling. Once the covering exhausts itself, price requires genuine new buyers to sustain momentum. If open interest does not begin expanding as price approaches 92 to 94, this breakout could stall and reverse. The COT report showing managed money at historic lows is a two-sided signal. Yes, it means enormous potential buying power is waiting on the sideline. It also means the speculative complex that has the velocity to drive sustained momentum does not yet have conviction that these levels hold. They are watching, they are not buying, and until they buy, this move lacks the volume confirmation that gives technical breakouts real durability and follow-through. Citigroup's $100 by March target was issued after silver had already traded at $121 and then collapsed into the low 60s. The path from $90 to $100 requires clearing 92 to 94 with conviction and expanding participation, not a touch and retreat. Every price level above the current market represents sellers from January's peak waiting to reduce their losses. That overhead supply is real. Narrative alone will not dissolve it. The broader structural case, the lease rates, the delivery stress, the COMEX inventory drain, these signals have been active since October 2025. They produced the all-time high in October. They produced the parabolic surge to $121 in January. They also produced the most violent precious metals correction since 1980, when margin mechanics synchronized and overwhelmed the physical thesis in a single cascade. The structural thesis being correct does not make every entry sound. Direction and timing are separate variables. Being right about direction and wrong about timing can produce the same outcome as being wrong entirely. Position sizing and risk discipline apply independently of structural conviction. Hold those constraints exactly as you evaluate what tonight's signal means for your situation. Here is where everything stands right now. Tonight, February 26th, 2026, silver spot is at $90.11 per ounce, up 162% year over year. Having just completed a confirmed breakout from a multi-week contracting triangle compression structure, the move occurred in tonight's session, with silver advancing meaningfully from the $87 range where it opened the week. Gold is at $5,191 per ounce. Central bank purchases totaled 863 tons in 2025. Expected institutional demand for 2026 is approximately 850 tons. Gold is anchoring the structural floor beneath the entire precious metals complex. Managed money net long positions in silver futures sit at 5,472 contracts, historic lows. This rally has not been built on speculative leverage. That makes it structurally different from and more resilient than January's paper-driven surge. Silver lease rates are running near 8% annualized in London, a level that signals severe physical supply and demand dislocation and eliminates the cross-market arbitrage that normally prevents sustained price premiums from compounding into something larger. Citigroup targets $100 per ounce by March, $150 as the upside case. The technical structure now confirms 92 to 94 as the next resistance zone, with $100 as the psychological and institutional threshold beyond it. Samsung has locked 100% of a mine's silver output for 2 years through direct prepayment, bypassing exchanges entirely. Tesla is structuring similar direct procurement arrangements. The world's largest manufacturers are communicating their assessment of exchange-based procurement reliability through their capital allocation decisions, not their statements, their actions. And 48 hours from now, on February 27th, the March COMEX silver contract reaches first notice day. Everything that has been building in the structural foundation of this market arrives directly at the delivery window, a window that cannot be deferred, managed, or redirected by any party. The window that opened at 5 p.m. tonight is the distance between recognizing a convergence and watching it fully resolve. It is the gap between primary data and next week's headlines, between structure and narrative, between being positioned before clarity and reading about the move after it has already happened. Before we close, I want your honest structural read. Does tonight's triangle breakout on historically light speculative positioning, with lease rates at 8% and COMEX first notice day 48 hours away, represent the beginning of the next sustained structural leg higher? Or is this a short covering rally that runs out of fuel before $100 becomes achievable on this timeline? What is the single element of this picture that the broader market has not yet fully priced? And what is the one variable that could make the directional thesis correct, but the timing fatally wrong? Drop it in the comments. Not the surface take, the real structural analysis. I read everything. If the argument holds, we build on it here. Every number in this report is verifiable. The COT report is published every Friday at 3:30 p.m. Eastern on the CFTC website. COMEX Vault data is updated daily on the CME Group website. Silver lease rate data is published by the LBMA. Citigroup's forecast is in their publicly available institutional research. Every data point has a primary source you can confirm in under 10 minutes. The ones who verify will understand tonight's signal before anyone explains it to them. The ones who wait for the explanation will read about it after the window closes. 1 minute ago, markets detected an unusual move. The window may be closing. The people who recognized what they were looking at 1 minute ago are not the same people who will read about it on Saturday. This is financial education, not financial advice. Verify before you act. John O.G. reports.